What if I told you that one of the most sophisticated, fastest growing tech, media, and logistics empires in America isn't actually headquartered in some, sleek glass campus in Silicon Valley?
Oh, wow. I mean, that sounds completely counterintuitive right off the bat.
Right. But what if I told you it's hiding right in plain sight? Like sitting behind that bright yellow and black sign selling $1 paper towels just down the street from you.
Oh, you're talking about Dollar General.
Yeah.
Yeah, we are definitely conditioned to look for innovation in the tech sector, right? Not exactly in the aisles of a neighborhood discount store.
Exactly. But when you actually peek under the hood, and for this deep dive, we are pulling straight from Dollar General's Q4 and fiscal year 2025 earnings report, plus their latest press release and the executive earnings call transcript.
Which is a goldmine of data, by the way.
Oh, absolute goldmine. And what you find in there is entirely different than the public perception. I mean, beneath that simple, kind of unglamorous surface, it's this fascinating case study.
Yeah, they are mastering the absolute gritty basics of physical retail while, quietly building this high-margin digital powerhouse in the background.
So our mission for you today is to uncover exactly how they're hitting these record margins, what happens to a massive national company when they just completely pull the plug on self-checkout.
Which is wild, by the way.
Totally wild. And, why all this matters to anyone trying to understand modern business strategy.
Because it really is a masterclass in operations.
Mhm.
I mean, you're watching a company balance some incredibly grounded defensive maneuvers with some surprisingly aggressive, futuristic offensive growth.
Right.
And the numbers they just reported, they completely prove that this dual strategy is working.
Okay, let's unpack this because the financial beat they just reported is massive. We're talking about Q4 net sales hitting $10.9 billion.
Yeah, it's a 5.9% increase.
Right, which is huge. But the real jaw dropper here is the profit. Their diluted earnings per share, which, is essentially the portion of a company's profit allocated to each individual share of stock. It rocketed up 122% to $1.93.
They absolutely crushed market expectations.
Crushed them. And their operating profit was up over 106% to $606.3 million. So my question is, how does a company selling dollar items suddenly double its profit in a single quarter?
Well, what's fascinating here is that they didn't double their profit just by selling twice as much stuff.
Right.
A massive driver of this profit explosion was a 105 basis point expansion in their gross margin.
Okay, let's translate that Wall Street jargon for the listener.
Sure, yeah.
105 basis points simply means their profit margins expanded by over a full percentage point, right?
Exactly. And in the retail world, where companies fight tooth and nail for like a fraction of a percent, moving your margin by over a full point is astronomical.
So how did they pull that off?
Mostly by playing defense, actually. They focused intensely on reducing what the industry calls shrink.
Shrink being the catch-all retail term for theft, lost inventory, and damaged goods.
Correct. And shrink improvement alone added 62 basis points to their margin in Q4.
So well over 0.5% just from stopping loss.
Yeah. And the way they achieved this wasn't through some, flashy new AI security camera system. It was actually a major tactical shift backward, operationally speaking.
Yeah, backward.
Yeah, they took out their self-checkout units and converted them back into fully staffed, traditionally assisted checkout lanes.
I find this so interesting because we have been told by the entire retail industry for, a decade, that automation is the only way to survive.
Oh, absolutely. It was the gospel.
Right. Self-checkout was supposed to be the ultimate efficiency play, the future of retail. It feels like they just patched a massive leaky bucket. But how does paying a human cashier an hourly wage actually make a store more money than a machine?
Well, because you have to look at the holistic cost of the technology, right?
Yeah.
Rather than just the isolated labor savings.
Okay, that makes sense.
So, sure, automation reduces your front-end payroll costs, absolutely. But you have to look at the mechanics of what happens at a self-checkout kiosk. You have accidental misscans, like where a customer scans a generic item instead of the premium one.
Or they just, forget that big item sitting at the bottom of the cart.
Exactly. And then, of course, you have intentional theft, which thrives when there's no human oversight.
Obviously.
So if that automation creates an environment where your shrink just explodes, those payroll savings are completely wiped out by the cost of the lost inventory.
Ah, so it's a math problem. The cost of the stolen or unscanned laundry detergent is actually higher than the wages of the person standing there to make sure it gets scanned properly.
Precisely. By putting an employee back at the register, they just stop the bleeding. They realize that the human touch isn't just about customer service.
Right.
It's actually a superior financial strategy for inventory protection.
That makes so much sense. But, stopping the leaky bucket of shrink is just the defensive strategy.
Right. You can't just save your way to long-term growth.
Exactly. You have to play offense, too. And they drove a 4.3% increase in same-store sales. Now, for you listening, same-store sales is a crucial metric because it measures the growth of stores that have been open for at least a year.
Yeah, it strips out that artificial boost you get just from opening new locations.
Right. So to grow that by 4.3% means they are getting way more value out of their existing footprint. How exactly are they doing that?
By fundamentally rethinking what they actually put on the shelves.
Okay.
Their offensive strategy right now is heavily focused on the idea that less is actually more.
Oh, really?
Yeah, they're aggressively cutting SKUs, which stands for stock keeping units.
Yeah.
Basically, the unique individual items they sell. They have cut over 1,500 unique items from their assortment.
1,500. That's a lot.
It is. And they are actively reducing those standalone cardboard floor displays to declutter their stores.
Okay, here's where it gets really interesting to me because that feels totally counterintuitive for a convenience store. Well, if I compare this to a restaurant, it's like taking a diner that has a 10-page menu with every food imaginable and shrinking it down to a single, highly curated page.
That's a great way to put it.
Right. But if I walk into a Dollar General, I expect them to have exactly the random thing I need. Isn't limiting consumer choice a massive risk?
It sounds risky, sure. But consumer psychology actually tells us a different story.
Really?
Yeah. When a customer walks down an aisle cluttered with 15 different types of ketchup or navigates around clunky cardboard floor stands, it creates decision fatigue.
Oh, sure. It's overwhelming.
Exactly.
Yeah.
By curating the selection, giving you 3 great options instead of 15, they actually make the shopping experience faster, more pleasant, and just less visually exhausting for you.
Huh.
But the real operational magic behind cutting 1,500 items is what it does to the supply chain.
Okay, how so? What's the impact there?
Think about the mechanics of stocking a store. When you have fewer, faster-moving items, you drastically improve what the logistics world calls case pack fit.
Case pack fit. I'm picturing a game of Tetris here.
That's exactly what it is. Imagine a cardboard box comes off the delivery truck containing, say, 12 bottles of shampoo.
Right.
If the shelf is designed to hold exactly 12 bottles, the employee opens the box, slides all 12 bottles onto the shelves, breaks down the empty box, and they are done.
Perfect Tetris fit.
Right. But if the shelf is cluttered with 1,500 extra random items across the store, maybe there's only room for 9 bottles of that shampoo.
Meaning the employee now has 3 leftover bottles they have to haul all the way back to the stockroom.
Yep.
Find a place for them, track them, and remember to bring them back out next week. That sounds like a massive waste of labor hours.
It is a massive waste of time and money. By cutting those 1,500 items, they ensure that the box coming off the truck fits perfectly onto the shelf.
Wow.
It keeps the aisles clear, it keeps the back room organized, and it frees up the employees to actually run those staffed checkout registers we just talked about.
That makes perfect sense.
Yeah.
The operational realities basically dictate the in-store experience.
Exactly.
And while they are simplifying that assortment, they are also simultaneously leaning incredibly hard into the psychological anchor of their brand, which is the $1 price point.
Yeah, they have a rotating selection of 500 items priced exactly at $1.
Which they internally call Value Valley.
Yes, and in an inflationary environment, that strategy is highly effective. That specific $1 segment saw a 17.6% sales increase.
That is a huge jump.
It really functions as a powerful psychological anchor. When you know you can reliably get certain staples for a single dollar, it builds immense trust and, drives foot traffic.
But they aren't just selling $1 consumables. The earnings report highlighted a major push into non-consumable goods, too.
Right.
Things like home decor, seasonal items, and apparel. And for the 4th consecutive quarter, these non-consumables actually outpaced consumable goods in sales growth.
And they are highly profitable.
Exactly. The plan is to launch 15 new non-consumable brands in 2026 alone, with a target to reach 20% sales penetration in this category by 2029.
And this is where we see them leveraging their wider corporate portfolio.
What do you mean by that?
Well, they have a newer, slightly more upscale, suburban treasure hunt type store called Pop Shelf.
Oh, right. I've seen those.
Yeah. And they are actively taking the merchandising insights from what works at Pop Shelf what home goods and seasonal items people love to impulse buy. And they are bringing those specific insights right into the neighborhood Dollar General.
Okay, so if we zoom out for a second, we have a physical store that is operating at peak efficiency. They stopped the shrink by putting human at the registers.
Yep.
They decluttered the aisles to fix the supply chain Tetris. And they curated the products to drive high-margin, non-consumable sales.
That's the foundation.
But this perfected physical footprint is actually masking what they're doing in the background. Honestly, the store itself feels like a Trojan horse to me.
A Trojan horse in what way?
Well, you drive past that yellow sign in your town, and it looks like a simple place to buy a $1 greeting card or some laundry detergent. But inside, because they have perfected the physical operations, it is now quietly operating as a hyper-local delivery hub and a highly profitable advertising platform.
Oh, absolutely.
I mean, compare this to what tech giants like Amazon do. Amazon built a massive digital storefront first and then had to spend billions of dollars and decades building physical fulfillment centers to get things to your door.
And Dollar General is doing the exact inverse.
Exactly.
They already have the physical nodes. I mean, they operate nearly 21,000 stores, and they are located within 5 miles of 75% of the U.S. population.
That stat is always wild to me, 75%.
It's massive. So they simply flipped the script. Instead of building warehouses, they turned their existing stores into warehouses.
Right?
They are now a delivery giant. They're active in about 18,000 stores, facilitating delivery through their own Mighty G service, as well as third-party partners like DoorDash and Uber Eats.
And the mechanics of this are wild because the speed is what really caught my eye. Over 80% of those orders are delivered in under an hour.
Which is incredibly fast.
It is. In the earnings call, they noted that delivery alone added a remarkable 80 basis points, so almost a full percentage point, to their Q4 same-store sales growth.
And think about how that works operationally. Because they decluttered the aisles and fixed the inventory flow, a gig worker for DoorDash can just walk into a Dollar General, quickly find the curated items, and get back in their car in minutes.
Right.
The physical store is the engine that powers this digital tailwind.
And it feeds perfectly into their advertising arm, too, the DG Media Network.
Oh, definitely.
Because when you use their app to clip a coupon or order delivery, you are interacting with a digital platform. Over time, they have built over 100 million marketable customer profiles.
Which is huge for advertisers.
Huge. And in 2025, they generated $170 million in retail media volume. How exactly are they making that money?
Basically, by selling your attention to the brands they stock.
Yeah.
Because they have those 100 million customer profiles, they know exactly what you buy, when you buy it, and how price sensitive you are.
Right.
Brands will pay top dollar to access that data. So Dollar General sells targeted ad space right on their app and website. If a major brand wants to make sure you see their new soda before you check out, they pay Dollar General for that premium digital placement.
But they are also extending that into the physical stores, right, with in-store audio.
Yes, and this is where the physical and digital really merge. A brand can actually pay to play an audio ad for a specific brand of chips, right, while you, the shopper, are walking down the snack aisle.
Wow.
It connects the digital profile to the physical experience. And as management noted on the call, this retail media revenue is highly accretive to their gross margin.
And that's financial speak for it is almost pure profit.
Exactly. It costs them very little to run an audio ad or display a banner on an app, but the revenue they take in from the brands goes straight to the bottom line.
Plus, behind all this customer-facing tech, they are building an AI operating system for the enterprise to improve internal productivity and decision-making.
Yeah, they're modernizing everything.
And logistically, they operate practically like a private shipping company. They use their own private truck fleet for about half of their outbound transportation.
Which is another massive cost-saving mechanism.
Oh, so?
Well, by running their own trucks, they control the routing, they avoid the markups of third-party logistics companies, and they can optimize the routes to ensure the trucks basically never drive empty.
Right.
They reported that managing this themselves saves them 20% compared to using third-party providers.
Wow, 20% is no joke at that scale. So my Trojan horse analogy holds up.
It absolutely does.
You have a neighborhood discount store that is secretly a massive tech ad and logistics network. All these profit pools, delivery revenue, pure profit advertising, supply chain savings, and reduced shrink, they're all just stacking on top of each other.
Which completely explains the 122% explosion in their earnings per share.
Right. So, with all of this momentum perfectly aligned, what could possibly slow them down? Let's shift our gaze to the horizon and look at 2026. They laid out their guidance on the call. They project net sales growth of 3.7% to 4.2% and an earnings per share between $7.10 and $7.35. And despite their digital success, they aren't slowing down their physical footprint at all.
Not at all. They're planning 4,730 real estate projects this year alone.
That is a staggering number.
Yeah, and that includes opening 450 brand new stores in the U.S. and expanding their footprint further into Mexico by adding 10 new Mi Superdollar General stores to the 16 they already operate there.
So what does this all mean for you, the listener? In an age where e-commerce dominates every headline and we constantly hear about the retail apocalypse and malls shutting down, is opening 450 new physical brick-and-mortar stores stubbornly old school?
It would be old school if they were just opening traditional stores. But based on everything we've discussed, they aren't.
Right.
Every single one of those 450 new physical stores is a strategic asset. It's a new hyper-local distribution node for under-an-hour delivery. It's a new physical billboard for their DG Media network to play audio ads. It's a new logistics anchor in a rural community where a giant like Amazon might actually struggle with the economics of last-mile delivery.
That makes total sense. The physical store is just the foundational infrastructure for their digital growth.
Precisely.
But they do face some very real macroeconomic realities in 2026. The earnings call didn't shy away from highlighting a few headwinds.
No, they were pretty transparent.
Yeah, for one, early 2026 winter storms temporarily disrupted their Q1 sales right out of the gate. I mean, people simply don't drive to the store in a blizzard.
Right. Weather is always a factor.
But there's also a significant tax headwind they mentioned, costing them about 150 basis points on their tax rate, which translates to roughly 13 cents per share.
Yes, this is an important financial reality for them. It's due to the expiration of the Work Opportunity Tax Credit at the end of 2025.
Can you break that down for us?
Sure. Just to provide the objective facts on what this is. It's a federal tax credit designed to incentivize companies to hire individuals from certain groups that consistently face barriers to employment.
Okay.
This includes hiring veterans, individuals utilizing SNAP benefits, and summer youth employees.
And because Dollar General employs a massive workforce across thousands of local communities, they naturally hire many people who qualify for this program.
Exactly, which earns the company a significant tax credit.
Right.
Now, Congress has historically extended this specific program multiple times over the past decade, often retroactively, but there are no guarantees it will be renewed again this time around.
Right, you can't bank on it.
Exactly.
Right.
As a publicly traded company, Dollar General has to budget for the reality in front of them right now, which means absorbing that 13-cent per share hit in their guidance.
Which makes total sense. You have to plan for the reality you are in, not the reality you hope Congress legislates.
Exactly.
But speaking of their financial reality, they are absolutely swimming in cash right now.
They are.
They generated $3.6 billion in operating cash flow, which is up 21%. And they're using that to retire $1.7 billion in senior notes, meaning they're getting rid of corporate debt early.
Always a strong move.
Definitely. But here's the part that surprised me. They explicitly stated on the call that they are not doing any share buybacks in 2026.
And this raises a fascinating point about capital allocation and corporate discipline.
And how so?
Well, very often, when a massive company has excess cash, Wall Street analysts will basically demand stock buybacks.
Right.
Buying back your own stock reduces the number of shares available, which artificially boosts the price of the remaining shares. It's a quick way to keep investors happy.
But it doesn't actually improve the underlying business.
Exactly. But management here is choosing operational discipline over a quick stock bump. They're redirecting that $3.6 billion in cash right back into the business.
Oh, wow.
Yeah, they are funding those 450 new stores, executing thousands of store remodels, heavily investing in their IT and AI modernization, and ensuring they can keep their employee wages competitive.
So they're playing the long game.
Completely. They mentioned they plan to resume buybacks when the time is right, perhaps in 2027. But right now, they are entirely focused on funding their own growth engine.
It's a remarkably refreshing long-term view in an era of quarter-to-quarter thinking.
For sure.
So let's pull all of these threads together. For you listening right now, if you want to walk away with the absolute core insights from this stack of earnings reports and transcripts, what is the ultimate takeaway?
The takeaway is that Dollar General is thriving, because they respect the gritty, unglamorous fundamentals of retail while simultaneously embracing a highly digital future.
Right.
They fixed the basics first. They recognized that automation was causing shrink, so they put human beings back at the registers to stop the bleeding.
Leaky bucket.
Exactly. They decluttered the aisles to optimize the supply chain, and they doubled down on the massive psychological value of the $1 price point to help consumers fighting inflation.
Yeah.
But they didn't stop at the physical basics. They took that perfected physical foundation and aggressively layered on high-margin digital innovations.
The Trojan horse.
Yes, they transformed their stores into a local delivery network capable of under-an-hour fulfillment. And they monetized their 100 million customer profiles through a highly profitable retail media network. It's honestly the perfect synthesis of old-school retail discipline and new-school digital monetization.
It really changes the way you look at retail entirely. It's not just about what is on the shelf anymore. It's about the network operating invisibly around that shelf.
Very true.
And I want to leave you, the listener, with a final thought to mull over next time you're out running errands. As companies like Dollar General continue to build out these incredibly lucrative media networks physically inside their stores and digitally on their apps, the fundamental nature of the physical store is shifting.
Dramatically.
Right. Are we soon entering an era where the primary purpose of your neighborhood store isn't actually to make a profit by selling you a can of soup, but rather the store exists to gather your purchasing data and serve you a targeted advertisement while you buy it?
That's a wild thought.
It is. The physical item you are buying essentially becomes a loss leader for your digital attention.
It is a profound shift.
Where?
We are watching the transition from a purely product-based economy to an attention-based economy, and it is happening right there in your local grocery aisle.
It really is. Well, thank you for joining us for this deep dive. Understanding the mechanics behind these corporate earnings reports, the surprising operational shift away from automation, and the invisible data networks humming all around us makes us all sharper, much smarter consumers.
Absolutely.
So the next time you take a drive and see that bright yellow and black sign, you'll know exactly the kind of sophisticated engine humming beneath the circus.